For-hire rates are finally improved. Profit margins are finally doing a little bit better than they have for the last few years, but for how long? I'm here in Columbus, Indiana for Act Research's Market Vitals seminar, talking with Tim Denoyer, VP and Senior Analyst for Act Research, to hear a little bit more about that. So Tim, thanks for hopping on.
Good to see you, Jeremy. Thanks for having me.
Oh, absolutely, absolutely. For-hire rates are doing good finally, so I think let's break it down. Supply, demand, and rates. We already know how rates have been doing. People are pretty well aware of how they've been doing since, I think, like November or December last year. What is the demand side?
The demand side's overall pretty flattish, I think is the general takeaway. It's really still a supply-led recovery. We definitely have a lot more to talk about in terms of the action on the supply side. On the demand side, some of that tightening on the supply side is actually creating demand. The pinch in the truckload market is creating intermodal demand and LTL demand in the adjacent modes, if you will. But overall, it's really not wonderful on the demand side, which isn't a shock given where interest rates are and given where the job market is and those types of things. We aren't expecting wonderful freight volume outcomes. The housing market, for example, is one area where we're pretty concerned at the moment, just given interest rates in particular. And the difficulty of the younger generation of owning a home. That is keeping that part of the economy relatively soft. The AI-driven investment boom that's going on is certainly a positive, but I like to point out that data centers don't generate very much freight once they're built.
It's great for flatbed, not much else.
Yeah.
So listeners might already be aware of how the for-hire supply side has been doing. What's going on?
Well, the supply side has a number of constraints, right? It's really pretty much everywhere you look on the supply side. The driver market in particular is probably the biggest deal, but equipment costs are going up, equipment availability is down, and so we talked a lot about that here at the seminar. There's a lot of concerns about the transition to the new low-NOx engines coming next year. And from a length of cycle perspective, a lot of these supply concerns, both on equipment and on drivers, suggests we may have a longer rate cycle than normal.
And when it comes to the enforcement, that's not changing anytime soon. English enforcement, CDL closures, ELD rules, that's all here to stay?
Well, I think we're probably past the largest impacts of those several actions, and a lot of them are going to be ongoing for a while. If we take the non-domiciled CDLs, which is something where there's sort of the most data for, something like 30,000 of them have already been removed. And so we're not going to remove 30,000 in the next couple months. And so you're seeing a little bit of a sort of return to earth, if you will, after these regulatory actions really drove spot rates up quite a bit in the first half.
And so when we're talking about what a supply-driven cycle upswing means, we're talking about this. Freight demand is sort of flat, but the supply side has decreased quite a bit, and it sounds like it's going to stay decreased for quite a while. Mm-hmm. You'd mentioned this is affecting, in some way, demand for LTL and intermodal. How does that work?
Yeah, so if we take intermodal in particular, because it's sort of the most volume heading that direction, it's pretty clear that the railroads have prioritized volume. There was excess capacity coming into this year, whereas there's really not a lot of excess capacity in the truckload market anymore. We've been a little surprised that the railroads haven't raised rates much. We're starting to see some peak season surcharges. The Union Pacific just put out a $1,000 per container surcharge. So we've been expecting that. But before that, intermodal rates were 40% below truckload rates because they didn't really move. The long-term average is more like 20%, just nationally. So the railroads are gaining in particular because they had equipment and they're really starting to turn it. And that discount is a big relief for shippers whose budgets have gotten a little out of control this year, both from a freight rate perspective and from a fuel perspective.
So freight rates are up. Freight rates continue to increase, especially on the spot market. Contract is sort of pretty close behind. How long will they continue to increase for? Are we expecting them to just crash right down anytime soon?
Yeah, that's a great question. And given what we just talked about on demand, this shortage is not going to be quite as hard to solve for as it would be if, say interest rates were really low, inflation was really low, and the consumer was really buying a lot of goods. And, I'm not saying it needs to be like a COVID type environment, but in a more goods demand promising environment, then you'd probably see a good bit longer cycle. And inventories are low. Retail inventories have inventory sales ratios are at 5-year lows. Wholesale inventory to sales ratios, which includes e-commerce, are at like 10 or 15-year lows. And so To some extent, it does feel like they're getting a little bit more efficient, and maybe some of that's structural, but there's clearly an opportunity for a restock out there, and it's just hard to see what the catalyst is. Overall, the length of the cycle, I think, is going to be very much driven by how, what happens with demand. It'll certainly be shorter if, interest rates get out of control and, hurt the economy even further. But the base case is that we have, good 2% type GDP growth going forward, and that drives a little bit of freight growth. And in that scenario, even if we get a little bit of demand growth, it's going to be so hard for the industry to add a capacity back because of these higher cost constraints and the driver issues that, you can make the argument both ways right now. It could be a little shorter than normal cycle. It could be a little longer than normal. And a lot of it will depend on financial markets.
Interesting. All right. Thank you, Tim, for joining me.
Thank you for having me.